Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, March the 1st. I hope everybody survived February. My name's Eric Wilkinson. Some of you may recognize me as the Woflman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. There is a long list of economic data coming out, especially across the pond, in the form of PMI, which is Purchasing Managers Index. One thing to keep in mind, though, these numbers that are coming out are some of the lagging indicators on the Purchasing Managers Index scale, if you will. Overseas, what they look at the most is their flash PMI. Here in the United States, we get flash PMI also, but that isn't our most important number because we get the Institute for Supply Management Manufacturing PMI, which is our most important number. It comes out before the flash PMI. It is the one that the Fed looks at. It is the one all of the traders look at for economic growth. So that's the one that we look at across the pond. It is flash, but we didn't get flash necessarily today. Basically, we got Spanish, French, Italian, German. Did I say Italian? Yeah, Italian, and the European regions. Final manufacturing PMIs all came in line with expectations, but again, those aren't the most important ones. Then in Great Britain, we got manufacturing PMI, again, also in line with expectations. That is one of their most important numbers. They don't really look at the flash. And then moving across the pond back to the United States, here we got our core PCE price index, which is personal consumption expenditures, more along the lines of the retailer or the retail consumer. Came in at 0.3%, expected to be 0.3%. Personal spending came in line with expectations at 0.2%. So both of those really pretty flat. We'd like to see those expanding, right? We're not necessarily seeing that. And then we got unemployment claims lower than expected at 210,000, expected to be 226,000. That's good for the overall economy. Less people generally claiming means that people are being hired. Personal income came in higher than expected at 0.4%. So we want to see that. Like we've been talking about seeing prices incrementally increase, inflation, if you will, price of gasoline, things of that nature. How do we compensate or overcome that hurdle? Personal income starts creeping up. That kind of offsets those. That's good to see. Then we also here in the United States got our final manufacturing PMI came in line with expectations as well, but that's not part of the ISM. That's the one that we're really looking at, which came in a little bit higher, which is good. Construction spending came in unchanged, zero, no change, no increase, no decrease, but they were expecting an increase of 0.3%. Institute for Supply Management, prices paid, manufacturing prices paid, I should say, 74.2, expected to be 70.5. Now, what we expect with this Institute for Supply Management prices paid, they're going to try and pass those higher prices off to the consumer. If they pass those off to the consumer needs to be able to pay for that. That's why it's really important to see that personal income move higher if we're seeing prices paid move higher. And then we also got natural gas storages came in at a drawdown of 78 billion cubic feet, expected to be a drawdown of 71 billion cubic feet. So pretty much in line with expectations there. We also had Powell testifying earlier today, Fed Chair. Powell speaking, not a whole lot to be said there other than, they're trying to keep an eye on the economy. And then we also had Trump speaking later on today, probably right now, actually. All right. Don't know if it's really affecting the market because he just started speaking for the most part. But let's get on to the overall markets. We've got crude oil continuing to slide. It did go down and test that $60 a barrel, but bounced away. The bulls came out and defending that. Now, if we get much higher than this, it is going to look like we have found some support. Right now, right in the middle, that's a little bit iffy. Any further down than where we are, that's just going to be a continuation. But if we can get back up here into the 61 handle, let's call it, by the close or at the close to close, however you want to say it, that would look to me like it has found a bit of a bottom here and would want to start moving higher. All right, on to Bitcoin futures. Not really sure, I think I've got these out of order, but Bitcoin futures we've got up slightly right now, 66 points, still in that in above 10,000. You know, that could be wiped out in a matter of seconds, but that's what I've been talking about. 10,000 is what they want to try and defend. A lot of athletes talking about crypto now. Everybody's getting involved. Even Richard Sherman from Seattle Seahawks is involved in cryptocurrency. A lot of guys taking note of this type of investment. All right, on to bonds. Let's get back to gold because I must have somehow skipped over gold or accidentally deleted it. I don't know where it went. Let's look at gold real quick. We've got gold futures coming off by about $7. Again, a similar situation what we were talking about. This doji not necessarily making it look like a bottom. We rally up and let's say get above the value area high around 1313. That sounds like a good ominous number. 1313 settlement would make this look like we found a little bit of support as well. Anything below this value area, it's going to make it look like it wants to go down and hit my target of 1280. I think it's I'm just bearish on gold. I don't really see necessarily the inflation trade, although we are starting to see some of that creep up in that ISM manufacturing prices paid, which should be passed on to the consumer. If so, we're starting to see that, then we should and then gold does have that room to move to the upside. Bonds unchanged for all intents and purposes. We talked about this getting a little overdone a couple of days ago. Yesterday, confirmation to the upside. Got just above that 9-day moving average, which is short-term bullishness. And we are kind of treading above that right now. But I'm in the camp. This big, massive sell-off, people are going to want to start covering. Should probably come to at least halfway back of that sell-off, I'm guessing. So, somewhere around the 147 handle, I think it's where we're going to see a little bit of a bounce. But if we keep getting these Fed governors talking about increasing interest rates, that may not happen. But I think that they're going to need to take a pause here and see how everything's working out, especially with the housing market. The interest rates increasing is going to crush California for one. They are the ones that are in these adjustable rate, mortgages or just interest-only mortgages still. A lot of those people have not gotten out of those and are going to be underwater again on their homes. We got VIX back in the 20s, back in the saddle again. Anyway, sorry about breaking your eardrums on that one. But anyway, back up into the 20s with the VIX. Like to see the volatility start to increase. I've been having a lot of fun with that. We got the Dow Jones Industrial Average off about 100 points right now. Had a big rally early this morning after the sell-off. We got a nice big pop in all the equities, but they have seen that very short-lasted and are near the lows of the day, as we can see here. As just by looking at the chart, you can see they're on the lows of the day. NASDAQ, similar situation here, near the lows of the day after a big rally. As a matter of fact, it rallied up above the 9-day moving average. I don't know if there's a whole lot that can be said about the charts right now. Even if we get this rally in the equities back up near unchanged, the doji from yesterday, the way the market's been acting at the end of the day, if we even got a counter-opposing doji, like, this is, it's like a spinning top doji is about as close as I can call it. This rallies up, we get a hangman doji. Anytime you get those counter-opposing dojis kind of lining up, that's usually a continuation pattern, especially when it's in the middle of a correction or a type of a move. I would still expect, even if we get the late day rally, that tomorrow is still going to see some bearishness in the equities. So with that being said, I'm trying not to be short any puts right now because I'm a little bit nervous about the downside, and not too overly concerned about the upside necessarily. Anyway, NASDAQ off quite a bit today and near the lows of the day as we speak. Back in that trend channel as well that we've been talking about. E-mini S&Ps down 15 points, near the lows of the day again. Again, similar situation. If we start rallying back up close to unchanged, it still very well could look like a continuation pattern. This doesn't look nearly as good as what the NASDAQ chart is setting up as, but as you can see, it's getting a little bit of consolidation here, so that could throw that a little bit of a kink, but we could start seeing the tech sector kind of fall off. This is what I was talking about. As the last couple hours approach, we're getting these real sell-offs into the late day where people aren't wanting to take these equities overnight. A lot of covering on the longs. Just the market has a tendency to fall out of bed towards the end of the day, and I kind of expect that to happen again today. But this is what I was talking about on the open. You can see we kind of rallied, got all the shorts out, and then the market sold to the downside. Sorry, guys, I'm running a little long today, but I've got to talk about a couple of trades that I've done. Let's talk about Budweiser, Anheuser-Busch, ticker symbol BUD. I played this to the upside for their earnings. And in my margin account, I went in there and sold the March that expire on the 18th. The March one. Did I do the March in those? I did the March that's expire on the 18th. I sold the 102 puts in there for 45 cents. Bought those back for 10 cents this morning. In my IRA, I did basically the same strikes, but defined that risk in Budweiser by doing the March 102 puts that I sold, and then bought the 96 puts to define that risk. I did that trade in my margin account for 43 cents. I had to pay up a little bit on the long puts to make up for that, and all I did was cover my Budweiser 102 puts this morning for 10 cents. So a nice little trade there, just leaving those far out of the money puts on for right now. And then in Best Buy, similar situation. Played this to the upside. I figured if Macy's knocked it out of the park, well, Best Buy's got to be doing pretty good as well for the Christmas season. So I played Best Buy to the upside, which I don't normally do, but with Macy's beat, I decided that this was probably going to be a play to the upside, and went in again to the March weeklies and sold. Those are March 18 that expire tomorrow on both the Bud and the Best Buy trade. So they're the March that expire tomorrow, and I did the Best Buy in my margin account. Sold the 66 puts for 70 cents, bought those back for 10 cents this morning. Over in my IRA, I did the same strikes with Best Buy, with selling those 66 puts in the March that expire tomorrow, and bought the 59 puts that define that risk. Kind of had to pay up a little bit on those puts, but sold that whole spread for 63 cents, bought back just the 66 puts for 10 cents, left on the 59 puts because they were basically worthless. Just going to leave those on. It's cost of doing business. So both of those trades covered for a nice little profit there. And then on to the next trade was Tesla. Now, if you guys remember in Tesla, I bought a long-dated January 2020 put, and I bought the 150 put. And I paid $11.20 some odd cents for it. So I decided to get real aggressive with this, which I don't necessarily recommend, but I'm very bearish on Tesla. The pattern set up quite nicely. I thought it was going to kind of come off. So I decided to go in there, and for every one lot put that I'm long in Tesla, I sold 10 calls against it. And those calls were really high. I was able to sell those. They were basically the March monthlies, and sold the 395 calls in there. So basically you can see the 395 calls are higher than this basic tweezer top here. So 395 really safe to the upside. So that's why I went a little bit went aggressive here just with the charts. I was able to sell these calls well above where the tweezer tops are, if you will. We've got this candle pattern. We got confirmation to the downside. I kind of went all in. Don't necessarily recommend this, but this was a super short trade. So when I went in there and sold those March 395 calls, I sold them for $1.23. This morning I bought them back for 23 cents. So all in all, I have on these long puts for about $100 each. So that is quite nice to have a 2-year put on for free. I might add a couple of other little short calls here and there, maybe even do some other things to lower my basis in Tesla, maybe even have those puts on for a credit. That's what I would like to try and do, but I covered those 395 puts that basically paid for my long duration puts. So Like I said, don't necessarily recommend it doing that, but it chart set up too nice for me to not do that, especially with high implied volatility and everything else going on in there. All right, and finally, the trade that I added today was in Intel Corporation. I put in both my IRA and in my margin account. In my IRA, let's talk about that one first. I went into the March, 15 days to go to expiration. Sold the 51 calls, bought the 55 calls to define that risk for 40 cents. Like to see a bit of correction here. You know, the reason why I did this trade, anytime you get these big gaps up, the market wants to fill in those gaps. There's a 50-cent gap right here that hasn't been covered that I think that is going to need to be covered at some point. But you can see the market wants to cover in these gaps when nothing's traded there. And I think that we're easily going to see this gap traded, and eventually this gap will be filled. But we haven't seen that yet, obviously. So I think that this market is going to come off a little bit, get a little volatility coming out with the market coming off. I don't know if I'm going to see much of that. But Intel, again, in my IRA, did like I said, the 55, sold the 51 calls, bought the 55 calls to define that risk for 40 cents. In my IRA, I went in there and sold those same March 51 calls in there for 46 cents. So, adding some negative deltas, my overall portfolio, it is pretty much overall negative delta now. And hoping for a correction here, because like I said, I don't want to have too many short puts on if we're going to see a correction. All right, that's about it for today, and all my short calls are in great locations. So, tomorrow's webinar is going to be on the long put butterfly. I'm going to explain why the long put butterfly is generally the better option option strategy than doing the long call butterfly. There are certain situations where the long call butterfly is the better strategy, but I'm going to show you how to pick and choose which one of these is the right strategy for your given market assumption, which we'll talk about in the commentary as well, or in the webinar as well. So go check it out at protraderstrategies.com. And if you can't take that, take it easy.